All right. So the difference between community and a scene. And as we were just discussing, so community is what you said, like basically people who cohabitate together.
Yes.
Right?
People who, cohabitate together.
Right. And a scene is more of a aesthetic functionality within that community. So
the picture frame within the
picture.
Yeah.
No, it's not a picture frame. Actually, it has nothing to do with. Think about before movies, people did plays. They still do plays.
What about setting?
Setting would be a background. Like this studio is a setting, and the scene is the thing that happens inside the setting. That's what in a play or in a movie or whatever. Right. So in the movie Almost Famous,
yes,
love
that movie.
When the kid gets brought into the rock and roll scene, it's filled with people who know each other. There's a community element to it, but they're also defined by the art that's happening or your relationship to the art. And it's it's kind of a movement, right? So typical scenes you might think of, it could be an art scene. It could be the Renaissance was a scene. It could be music. It could be skateboarding. But it's something that is there's an aesthetic element to it.
I always think of the hippie scene.
Sure. Yeah.
What is that, the 60s, 70s?
Yeah, it's late 60s.
Yeah.
Yeah. And what's funny about that is Woodstock is kind of the pinnacle of the hippie scene or whatever.
Right.
That was it was a really short scene. When you look at historically.
It really wasn't that long.
It was a very short scene. Anyways, so the scene is what kind of draws people in. So you could have a skateboarding scene, and that's just filled with people who like to skateboard, and there's certain music that they listen to or movies that they listen to. There's a vernacular, a dialogue that they all share, and then they get to know each other, and then they have a community.
Okay.
Right. So what I've always been interested in is community.
Yeah.
That's something that we've talked about a lot. And sometimes you start at a place because you're drawn into it by the scene. And then you get in there and you're like, wait, is this the community that I was looking for? Or is it kind of a transient scene? And the reason I'm bringing this up today is because when we left our prior firm, I looked at it as an opportunity to establish a scene, quote unquote, within our little firm. And then
build a community.
Build that community, right? With our clients and prospects and colleagues, et cetera. And I think the way I think about things is craft. I'm crafting that in my mind as a storyteller, right? Does that make sense?
It does. Yeah. I vibe with that because we've gone back and forth on this, and I've always been kind of lost on whether or not the community is the clients or the other firms that we're friendly with, or the COIs that we've become friends with, or whoever it all is, or just even our own employees and you and I and all that kind of stuff. So I guess the way that I would probably frame it is to imagine the perfect scene and then build a community around it.
Yeah, exactly. Design your scene. Then that brings the people in they find that scene attractive, and then you can establish community and relationships with them. And sometimes brands will establish a scene, quote unquote, in the most marketing horrible way that you could describe it, and then they lose the through line, they lose the narrative, they lose the story. And what I've realized is that I have such a it's such an emphasis, it's such a priority to me, that even though it sucked, I was willing to give up my equity ownership in that other firm.
Good.
Look at that transition.
I was trying to think how you're going to transition into this conversation today based off of that, but I have to give it to you. That was a good one.
Welcome to the Compound Growth Podcast with Colin and Wheeler, where we talk all things growth, from financial growth to career growth, personal development to societal progress. We explore how each layer builds on the next, compounding over time to shape who we become. Each week, we break down complex ideas and emerging trends into clear, actionable insights. Because growth isn't just about numbers, it's about understanding the world and our place in it. The information in this material is for general information only, and is not intended to provide specific advice or recommendations for any individual. Investment advice offered through Integrated Partners, doing business as Ko-Fi Advisors LLC, a registered investment advisor. Integrated Partners does not provide legal, tax, mortgage, advice, or services. Please consult your legal tax advisor regarding your specific situation. Past performance is no guarantee of future results. All investing involves risk, including loss of principal. No strategy assures success or protects against loss. The economic forecasts set forth in this material may not develop as predicted, and there can be no guarantee that the strategies promoted will be successful.
So talk me through what that means giving up your equity.
You and I had equity compensation that we received from our previous employer as employees at that company. And I received some equity compensation to join the company. It was a part of like my sign-on bonus. And then each year we would have more equity accrue, either through just kind of like our production, like our achievements, or some sort of company benefit.
Right.
Becomes over time kind of like a golden handcuffs situation.
Yes.
And I broke free.
We had a lot of conversations about separating from the firm and leaving that benefit behind.
Yeah. There's so many people who can't do that, though.
There are so many people that can't do it. And I'm not saying that everybody should, but it's something that we talked about a lot. And it is a conversation that we're constantly having with clients.
Yeah.
And it's a conversation that always comes up in regards to planning and benefit packages is stock options.
Yes. Equity ownership, equity compensation.
Yes, very much so. And actually, I think one of the reasons that, I really wanted to talk about this today is because we had a prospect come in a few weeks ago that worked for a tech company, and she had all of these grants and vesting schedules and, employee stock purchase plans and RSUs, all these different things that she had going on. And she did not know how to navigate it. And we talked to people all the time about this. And as we were having those conversations, I saw something that was pretty crazy, which was on TikTok. And there's this guy on TikTok that reviews benefit packages.
So, and that's total compensation benefit packages.
Total comp. So basically someone from Meta or Facebook or name the company,
the same company,
Meta or Google or Apple or whoever will submit their job offer.
Yeah.
And he will review it.
Wow. That's bold.
Kind of cool.
Yeah.
And one of the ones that was submitted, I thought was pretty crazy. I'm going to read it to you.
Okay. Please share.
Okay. And we're going to get into other examples of stock options and RSUs later on in the episode.
Yeah.
But there are different levels when you join a tech company. And it's the same way with many other firms as well, where basically you're ranked on levels from like 1 through 9 as the most entry level to more senior being level 9.
Okay.
And your comp goes up with them.
1 through 9. Why is there no 10?
There might be a 10. It's probably C-suite at that point.
It's just like, it's a random place to stop in. Sorry.
Yeah, no. It's all good. I don't know why they rank them that way. But anyway, so one of the ones that was submitted was for a Google L9 software engineer. High up there. So you're talking like 10 to 15 years of very specific industry experience, leadership, all of that kind of other stuff. The base salary package was $480,000.
Okay.
Base salary. Pretty good start. Annual bonus of right around $130,000.
Okay.
Of cash bonus.
Cash bonus.
Stock RSU bonus of $1.375 million.
Okay.
Annualized.
Yeah.
And that's a 4-year situation.
Okay.
So basically you're talking roughly a $5.25 million stock package with vesting rules.
Okay.
And he was comparing that against some of the other packages out there. And it was mid-level. It was mid-tier.
That's a mid-tier for a level 9 software engineer.
Correct. Like if you go to Meta, their stock RSU bonus package is far superior. But there are different ways to evaluate this. I was watching this the other day, and that's how this all came up. Is because we've had multiple conversations with clients about this recently.
Yeah.
I saw this online, and then it made me think, how can someone easily identify if a package is good, what the difference is between RSUs, employee stock purchase plans, all of those types of things.
Yeah.
And just how to go about thinking about this, because it's such a huge wealth builder for people. that I want to make sure people get it right.
Yes, I mean, it's really important, especially in that situation where the compensation is more equity than salary, right?
Yeah.
So that's, I mean, that's a heavy evaluation.
Yeah.
And it can go the other way, obviously, where, the equity compensation is a really small part of the total compensation package.
Yeah.
And at the same time, we've worked with clients that have been able to achieve some of their financial dreams because they had that equity compensation element to it, and some of the choices that they made along the way help them either retire early or just find financial success. And it's really, really important to be actively engaged in those decisions, because if you have some missed opportunities, you can really miss out on some long-term options.
Oh, 100%. The other thing, too, to keep in mind is as you become more senior in these roles and as you become more valuable to the company, your compensation goes from being probably 60 to 80% salary based to actually flipping the other way. Like if you looked at this offer, it's 60 to 70% stock based
Yeah.
because they want to keep you there longer. So
Yeah.
you really have to understand these things as you become more senior and you move up the ranks, that the stock conversation is going to be an even bigger thing for you moving forward in the future.
All right. So we're talking RSUs, ESOPs, stock and equity options. Where do you want to start, Colin?
Let's start with RSUs.
Okay. What
RSUs.
is an RSU?
So restricted stock unit. So basically what it is it's awarded to you from the company.
Yep.
You did not purchase it. It is a part of your benefits package. So what that means is oftentimes when you sign on with a company, just like how I read with that offer from Google, you are awarded stock from a company in the form of grants, basically, is the way that that's set up. And you have a vesting schedule, which means that let's just say that there's a 4-year vest and it's an equal amount every year. Let's say your total package over a 4-year period is $1 million. What it's going to do is it's going to divide up that $1 million grant at the date of grant over a 4-year period. So in theory, it would be 250, 250, 250,
Got it.
250.
Yep.
So that's the setup of it, but we know that it might not actually be 250.
Right, because the stock value can change.
Very
Right?
much so.
It's based on the value at the time of the award, not the time that it vests.
Yeah, and that was the conversation I had with the client the other day is they received in their welcome offer, a healthy stock package in the form of grants when they signed on, and the value of them dropped significantly over the last few months as tech companies have.
Yep.
We know tech sold off and some of the
Yeah.
big ones have come down pretty dramatically. So what would have been, a pretty healthy 6-figure stock package ended up being much less than that on her first vest schedule.
And there's so many things that just come to mind right then, right? Like, what do you do? What happens if the company you're working for, the stock loses 30 or 40% of its value at the time that equity is vesting for you and you finally have access to it?
Yeah, 100%. Well, I think that's like the big question. And we'll talk through this as well when we like talk about evaluating certain things. But when it comes to these schedules and these RSU packages, if you're leaning into a company that's very equity based in your compensation package, you have to have a lot of faith in that company
Yeah.
that they're going to continue to perform if you're going to tie your compensation and future well-being to it financially.
Let's walk through that scenario. Right.
Okay.
So let's say that you received $1 million in RSUs in Salesforce
Okay.
when you signed on 4 years ago. And now all your shares have vested, but Salesforce is worth 40% less. So you have a $600,000 value in those shares instead of $1 million.
Yep.
How are you taxed on those shares?
So the way that you're taxed on those shares is, let's use the example of a 4-year vest before. And we'll just keep it easy. Companies have different vesting schedules. Some of them are front loaded, some of them are back loaded.
Mhm.
But in this example, just to keep it easy, we'll say it's 25% a year over a 4-year period.
Yep.
And we'll say it's annualized. So if that's the case, then if it's $1 million, what it would do is it would basically look at the value of those shares at the vest date,
Mhm.
and you would be taxed on it as income when
So
it
$1
vests.
million as in income, right, at vesting.
Well, yeah, but if it's a 4-year vest, it would be 250,
Okay.
right, the first year. But if the company went down in value,
Sure.
then it might be a lower tax burden. If it went up, then it's a higher tax burden.
You could look at it and say, if the company loses value, let's say that I want I'm going to own this stock for a while. You almost want to lose value
when it vests, so it can recover.
And then you can recover. Then let's say that you hold on to those shares. You say, I really believe in the future of Salesforce and agentic AI and blah, 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 blah. And so now I'm going to wait for my $600,000 to go back up to $1 million. And let's say over the next year, that's what happens. Then I want to cash out. What do I pay?
Then you're taxed at capital gains.
Okay.
And if you hold it for more than a year, then it's long-term capital gains, which is a much favorable tax rate, usually, than your income tax.
Yeah.
So I can't remember the exact number, but I think the 10% capital gains bracket, if you're married filing jointly, goes up to, in the right around 500,000.
Is low.
Yeah.
Yeah. It's 15%. And then
15%. Yeah.
So okay. So that's one of those scenarios where you could bet on the future success of the company. You're working for it. You're like, I think the stock's going to go back up. But then what if it goes down?
Well, then that's the other thing. So if it goes down in value, then the value of those benefits has gone down. So in theory, your total comp package at that point is kind of less than what you had originally anticipated. So that would mean that, let's just say you had 1,000 shares at, $250. So $250,000 is what the original grant was supposed to be and invest in that first year.
Yeah.
If that's the case, and if the value of those shares have gone from 250 to 200, then that's a $200,000 grant that would vest after that first year, and you would be taxed on the 200, not the 250.
Yeah.
So you paid less in tax, but the value of it is less.
Right.
But you have to pay taxes on that. Companies do tend to withhold when the RSUs vest, and you take those and sell them and do whatever you want to do with them.
Yeah. But you don't have, so like the difference, if you were just like a guy on the street, like we don't work for Salesforce. So let's say we want to go buy Salesforce stock, not an investment recommendation. And you say, well, I'm going to ride this out and I'm going to, let it grow for 4 or 5 years. I'm going to be taxed capital gains tax on it. And I have control over that situation. Whereas when it's a company benefit, you have limited control.
Yeah, exactly. So if you were to just buy the stock outright, you have control over that. When you have an RSU, that's restricted, hence the name. But with that being said, if you're really negative about that company, and let's just say you have all this money vesting over a 4-year period, there's nothing you can do about it.
Yeah.
That's your bonus. That's what you're going to get. That's what you signed on for. That was your comp package. But if you just own it outright in your brokerage account, then you have total flexibility. And in the same way that after it vests, if you hold on to the stock, then you have more flexibility on what to do with it too. And you can use tax losses to help reduce your future burden as well.
Yeah. So that becomes kind of like just everybody's experience. Once you own the stock, it's fully vested. You're the same as any other investor.
Yeah, exactly. So you're basically the same as any other investor at that point. But, with that being said, you do have other tools to be able to acquire the stock when you're at some of these companies, such as an employee stock purchase plan,
right?
Which usually allows you to go in and buy the shares, oftentimes at a discount. But those are your shares. You put your own after-tax dollars into it. And then if you hold those for a year, you sell them, that's capital gains.
What does that discount tend to look like? I mean, what are some examples of some discounts that you've seen?
So an example that I saw recently for a healthcare company was a 10% discount on their stock price. So if it was trading at $200, you would buy it for $180 at that point. And it incentivizes employees to purchase the stock and kind of, I'll say benefit from that discount. So we do see a lot of taking advantage of that, where it becomes kind of tricky. And this was a client conversation, same client that I was talking about, was they had huge RSU compensation. Then they also were contributing pretty dramatically to the employee stock purchase plan. So they had even more of their net worth tied up in the company stock, which, hey, if the company stock goes up, that's great. But it's very little diversification. Like there are other ways to get more diversification with maybe some of your other benefits through, say, a 401k or a mega backdoor conversion in plan. There's a bunch of different ways to get it done. But just keep that in mind.
Yeah. I mean, if you are fortunate enough to work for a company in which the stock and you own stock right in the company and it massively appreciates, then you're in a good situation because you've increased your wealth, but you've concentrated all your wealth in one company. Right. And that one company also pays your bills on a basis.
It does. Yeah. I mean, it's very risky to have so much of your net worth tied up into a single company.
Yeah.
We all know horror stories of companies that, were shining beacons of the future that completely fell apart.
Yeah.
And that's why, diversification is such a strong thing that we talk about. But certainly a lot of people have gotten very wealthy over concentration as well.
Yeah. And, we have a lot of clients that work at a beverage company that has a really good employee stock option plan, purchase plan. Some of the employees that work there have a 40% discount on the stock.
That's huge.
So it's a great, and it's a 4-year cliff vesting. So it might be 5, but it's a cliff vesting and they're buying at such a discount that it's really hard to argue against that purchase option. We have clients though that we've worked with for, well over a decade, and that price has been really volatile. So a 40% discount is a really great buffer. It kind of like buffers out some of the volatility of the stock as it goes up and down. You don't have to worry about the decline as much because getting down to that 40% discount, that's a really aggressive decline.
It is.
To get worse than that is not all that likely.
Right.
But we have clients that because they build up so much wealth in that company, they have a really hard time selling the stock. And I've worked with clients that I couldn't convince to diversify or that diversification was in their best interest, and their wealth has dropped precipitously as the stock has underperformed. And I've had other clients that listened, or maybe didn't listen right away, but when the stock went down, they started to listen and they diversified their risk. They got off that plunging roller coaster and they were able to retire early. It's the risk aspect of this is always what I'm kind of drawn to. And it makes it hard for me sometimes because I know that there's an opportunity that I'm almost like just vibrating away from. I'm like, that's a massive opportunity, but it's also a massive risk.
Yeah, I totally get that. You mentioned something that I want to unpack.
Unpack something.
Cliff vesting.
Yes. What is cliff vesting?
I was just going to ask you that. You brought it up first. You talked about a 4-year cliff.
So as you just said, there's the different vesting processes, right? Yep. Like it could be annually vesting, or it can vest all after like this 1 4-year or 5-year period.
Yep.
And how much this compensation package that you were talking about, that, the L9 compensation package, what happens if they sever employment along the way? If it's vesting all at the same time, 5 years down the road, and you only make it 2 or 3 years, you're missing out on that equity compensation. And I don't want to say that people gamify that, but it could be a factor in whether you are still employed when they're doing a head count.
I was reading last night, just as I was prepping for this, what the average tenure is for a software engineer at a tech company.
What is the average tenure?
2 years.
Well, that's not great.
So something that becomes like a big factor when it comes to these packages is the vesting schedule. Oftentimes, depending on what it is you're trying to achieve and how mobile you are and your goals and how quickly you want to advance, it's possible you might not be with a company for very long, or it's possible you might be with a company for very long. And that changes the value of certain packages, because in your example, the cliff vest at the end, if someone's looking to just get into a company, get great exposure, and then use that to advance to another company, that's not a great package to necessarily go with, because you're missing out on total comp, versus other packages might have a more front-loaded comp package in the beginning, where it's more like a 30 or 40% upfront vest for the first 2 years, and then either 10 or some lower amount in the later years. And that's a very important caveat that people don't often consider with these comp packages, because life does change.
And you know what also people need to consider is their ability to negotiate, right? Like if you're leaving Meta to go to Google, you can say, I have $2 million in unvested shares. Can you match that? Can you give me some sort of vesting schedule in
100%.
order, right? Like, I think the importance of focusing on the value of your work, of you as an employee or a member of the team, it's really easy to get like stuck in this kind of idea that you get what you get and you're just fortunate to have it. And it's, historically speaking, when women have done they've had a harder time advocating for themselves. And that is one of the ways in which they miss out or fall behind in wealth accumulation in these industries. If they're both L9 techs or L9 software engineers or whatever, and there's that gender diversity, if women don't really advocate for themselves, like men, I guess, feel born to do, like you have to be able to
Men tend to be
negotiate. You have to be able to negotiate and have inflated senses of our value.
I've seen Survivor.
You have to negotiate.
Yeah.
And you have to negotiate no matter who you are. The first offer should not be the final offer.
One thing that I think is pretty powerful is looking back through history and seeing the evolution of the RSU benefits package conversation change so much. Because I remember when I started in this industry back in the day, RSUs were a topic of conversation, but certainly not as heavy as they are now. And I was just curious about this. I was looking back and I said, how much of the RSUs grown? And this is a ChatGPT exercise. And 94% of public companies offer an RSU benefit to their employees.
Yeah.
You were to go back to 2000, it was less than 20% for US publicly traded companies.
Yeah.
And then if you think about it, think about the fall of the pension.
Yep.
I'm not saying RSUs have replaced the pension, but if you think about incentives for these major companies to offer stock options and employee stock purchase plans, it's benefiting them because their stock price is going up. It's like gets everybody a seat at the table versus, a pension before was an expense for the company that they would have to pay out to all of their employees. So I think we're going to continue to see the RSU conversation evolve and become a bigger conversation moving forward. It's certainly here to stay.
Well, equity compensation is a line item in every earnings report. And
Right.
It is, to your point, something that is a little bit more fungible. Like they can manipulate that by shrinking headcount.
100%.
And with a pension, you're kind of stuck with what you are. Right. So that's a really good point. It's also, gosh, it ties into so many of the conversations we've just had about deferred gratification, right?
Mhm.
Getting a seat at the table, getting a seat at the American dream, the Trump accounts, et cetera.
Yeah.
And it's really exemplary of the evolution of how we look at equity and stock and ownership and finance and just everything inside this country. It just goes more and more and more towards capitalism.
100%.
And ideally, more and more and more towards individualization within capitalism, because you get to control that to a degree. But yeah, it's a really interesting trend. That's a good point.
Yeah. Well, it's almost like your community becomes that company that you're within. If you're so heavily vested in it, going back to your community, same thing before.
Yeah, it's a rah, let's go team.
Because if your net worth is really tied to that company, you want it to do well.
Yeah.
I have 2 examples of comp packages that are currently available.
Were
right
these
postings.
Were they reviewed on Twitter or whatever it was?
No, I actually found these. And something that I think is a useful thing to think through is not just total comp. And we touched on this briefly.
Yep.
But the amount of cash you're receiving versus the amount of stock you're receiving versus the vesting schedule you're receiving and how much that matters. And I think we can talk through these 2 examples and maybe stack rank them and talk through some of the differences and similarities.
Do we get to pick?
We do.
Can I choose one of these?
Of course you can.
Sweet.
Yes.
All right.
So get your resume ready.
Okay. I have not had a resume in 2 decades.
Probably about the same for me. It's full of dust right now. All right. So the first one is a software engineer, L5 level. Okay. At Google.
Yep.
Base salary, $195,000. Target bonus of 15%. Call it as near as makes no difference, $30,000 of cash bonus a year. Let's use $320,000 over a 4-year period with a front-loaded vest.
Okay.
33%, 33%, 22, and 12. And a one-time sign-on bonus in the first year of $40,000 with a subsequent sign-on bonus of $30,000 in the second year.
Do I have to live in California?
You do. Okay. Mountain View, California.
All right.
So talking through this, summarizing, front-loaded vest, $320,000 in RSUs, spread out over a 4-year period, but mostly upfront, 66% in the first 2 years, and $195,000 base salary with a $30,000 upfront target bonus and a $40,000 sign-on bonus. So your total year one comp for this particular situation is $369,850. Option 2. Curious to hear what you think about this one. Amazon.
Okay.
You're familiar with the company?
I've heard of it.
Yep. Okay. Sounds good. Senior software engineer, L6 level.
Okay. Better title. Right
Better title. Similar base comp, $190,000. Target bonus first year of $38,000. Then you have RSUs of $400,000 over a 4-year period. However, they backload the vest. 5% first year, 15% second, 40% third, 40% fourth. You already have an opinion. However, your sign-on bonus in year one is $80,000. So you have a target bonus first year of 38, a sign-on bonus of 80, and a base salary of 190 with a 5% vest. So what that means is your year one total comp is $328,000, but the latter half of your comp in years 3 and 4 is $388,000.
But year 2 is much smaller, right? Because you don't have that sign-on bonus.
Correct. Yeah. So your year 2 sign-on bonus drops from 80 to 60. So very similar in terms of total comp amongst both packages, but it's amazing how different the structure is. And they sound similar. Like if someone was to be presented with those two things, you would be like, oh, well, I'm basically just choosing between the two companies. But that's not true. There's huge differences between them.
Well, you know what's also interesting? I mean, the average person might receive that and not even pay attention to the vesting schedule.
Totally.
Right. And you're drawing a line and focusing on it. And that's very helpful.
Yeah.
Because otherwise you're focusing on the frontline numbers, especially an $80,000 sign-on bonus.
Right.
Does it seem a little arbitrary that there's these tiny other bonuses of 30,000? Like compared to all the rest of the income, your annual bonus is like nothing. And it requires you hitting certain metrics in order to get it. Whereas the other ones are just kind of like a given.
Fair.
You know, the one you have to work the hardest for is the smallest form of compensation.
That's true. I think one thing that really sticks out to me, and the reason why I'm highlighting the vesting schedule so much, is because you better be committing to being at Amazon for 4 years, or else you are leaving serious equity on the table. And this is assuming the stock price remains flat. You know, like the thing with the Amazon package is we're talking about that in year 3 or 4. We know a lot can happen in the market in 3 and 4 years. It can go up, it can go left, right, sideways, wherever you need it to go, it can go. But the fact of the matter is that you're committing to this company in terms of your total comp for those years 3 and 4. And if you were to leave in year 2, just like what we were saying before, you're leaving a ton of money on the table.
Yeah. And you'd have to negotiate again, like I was saying. But you know what? I think I would pick option A, but it's not just because of the better vesting schedule. It's because of my thoughts on the company as well.
Totally.
Right? So you have to kind of you have to have a thesis, like an assumption on what the company is going to do, what both of these companies are going to do, and how they're going to be rewarded for that, and their compensation and the equity growth.
Yeah, totally. Because when your comp is tied so much to the actual stock of the company, that makes a huge difference. Now, granted, too, we talked about it. You know, you can kind of play the game where, well, maybe if the stock's down, you hold it and, you know, you let it recover if you have, you know, confidence in the company long term. And on top of that, if you delay selling it, if you don't need the money right away, then ultimately you can play games with tax losses. And there's a bunch of different strategies that you can use to help diversify and mitigate your taxes. But when evaluating these things, I think it's really important to keep the vest schedule in mind, keep, you know, the idea of what it is that you're looking to achieve long term, whether or not you see yourself long term with this company or how long you see yourself with this company. And then ultimately kind of evaluating the upfront versus the back end will make a huge difference in your financial plan long term as well.
Yeah. Well, speaking of financial planning, I do think that when you're looking at either of these situations from a near-term financial planning perspective, you have to think about all of this deferred compensation as deferred. Like
Right.
it's not there for you to plan to live off of, even if it's vesting quarterly, or I mean, not quarterly, but annually, like you have that additional compensation. It shouldn't be part of your assumed living expenses. And you shouldn't, I don't think, even tie them to, I made this mistake when we were at said former employer. And I had a schedule of when different shares were going to vest and different income was coming my way.
Right.
I tied it to certain goals. I said, when this vests, I'll pay off this student loan. And
Right.
when this vests, I'll pay off this student loan. And that was perfect on paper. And then we left. And then I said, well, I guess I need a new plan. And I think one of the reasons it was hard for me, even though I valued what we were building more than just getting paid this deferred compensation at that company, was realizing that I had already mentally accounted for paying off something with that money, right?
Well, I mean, ultimately, whenever you make these decisions and select a company and go through this, it's an investment decision.
Yeah.
You know, like by signing on to one of these packages and thinking through your RSUs and even at the top level ISOs and things like that, you know, you are making a personal investment decision and you really need to evaluate your faith in that company. Because if you're going to tie your net worth to it, you have to have that confidence because it makes a huge difference. And certainly a lot of people will get their stock options and just sell them right away. But other people have a ton of faith in the company and they hold them. And that's sometimes how real wealth is built. And we've seen that even with a lot of our own clients who have, you know, legacy stock positions from companies that they were at that have just appreciated like crazy. And, you know, now we're coming up with strategies to trim them over time and make it tax efficient and manage them. But it's a pretty big thing to think through.
It is. And the fact that we're thinking about your income, it's not salary, but your income and an investment, like the way that, to your point earlier, the way we've had to evolve and change and evaluate income and how it's just creeped into evaluating investment is really kind of mind blowing to me. And it's, you know, again, it doesn't have to be $1 million packages. You know, there could be a 30 or 50 or $100,000 benefit that could be really meaningful to some people, but it's still tied to the success of the company.
Yeah.
And it can never be presumed.
Comp packages are becoming more complex.
Yeah.
And when complexity steps in, it's really important that you do your research to figure out what it is that you're signing on for, understanding all of these things. And if you don't, and if you want a second opinion, it's important to reach out to someone like a financial planner who can help you with something like that. Because we could be talking, like you said, a smaller number that's still very impactful for someone, or a very big number that's going to be a multi-generational planning opportunity. And you don't want to make the wrong decision when it comes to those types of things.
Do you want to get into anything that you can do to sort of offset some of the risk in that in the equity that we receive?
Yeah, I mean, there's certainly things that some brief strategies I think that we can touch on. I think tax loss harvesting is probably one of the big ones. You want to talk through that?
Yeah, I mean, I think the idea of let's just keep using Google because it's just a name we can use. You know, Google is a stock in the S&P 500. There are a lot of companies that or index funds out there that will have a Google investment as a part of it. It might be a 5 or 6 or 7% weighting, depending on how the company performs in any given year. But that's only like, let's call it 70,000 out of a million. If you've done the other and you have like, let's say you have $100,000 in index fund and $1 million in Google, you are 93% invested in Google. So what we want to try to do is diversify that risk across all the rest of those 500 names.
Mm-hmm.
And if we can start to build up in an individual account a fund that or a strategy that owns individual stocks and not just the index fund, we can first of all exclude Google because you shouldn't own it over here if you own so much of it over there.
Yeah, you don't want that overlap.
Right. And then you want to start to loss harvest along the way when the market goes down, right? Sell Coke, buy Pepsi, et cetera, is the old adage. I think that's a really good way to do it, but it's also just being really intentional. You shouldn't own Google anywhere else if it's 93% of your portfolio in one place.
Right, exactly. Yeah, you don't want to have too much overlap in your portfolio in general. Now, this isn't investment advice. But with that being said, I think anybody that has one of these big packages understands that, it's a meaningful amount of stock in one particular company. And certainly that's how net worths and I'll say wealth can be created and destroyed simultaneously. Yep. Coming up with a good strategy to help you offset the taxes from it that you're going to be paying in the form of capital gains and maybe even some other strategies along the way. Diversification and figuring out how to manage these vesting schedules along the way and what to do with them is such like a crucial thing that you need to have a plan for.
Yeah, I mean, if you can use some losses that you harvest and realize in some other place to chip away at that iceberg of Google stock that you own in this other place, I think that's it's a really valuable approach. And there are ways to kind of accelerate that strategy. They're a little bit overly complex for us to get into.
Right. Yeah. But know that you have options and know that, when it comes to these types of packages, evaluating every aspect of it is important.
Yeah. Cool. I think that's a great place to leave it.
Agreed.
Great job today, Colin.
Oh, likewise.
I do want to encourage our listeners to start to reach out and share their thoughts with us. We should ask people to like and subscribe.
We should. We never do.
We never do. And we're going to do a better job of asking for that, like referrals. Yes.
Exactly.
Yeah. You don't get it. You don't miss 100% of the shots you don't take up. But also, what I find more often than not is when I am getting ready for one of our mailbags, it's not a question, but it's a correction that's coming in from one person or another. Feel free to correct us or share your critiques. Yes. Or just tell us we're doing a great job.
If you're a listener and you want to either leave a comment or reach out with also suggestions on future episodes, it might be a good thing.
Yeah.
Reach out to Tori.
Yes.
Tori at kofiadvisors.com.
Now that's out there. I feel like info@kofiadvisors.com might be a better place. You can just
this episode goes viral. I'll feel bad for your inbox, Tori. It's my fault.
All right. Thanks.
Compound Growth with Wheeler and Colin, sponsored by Ko-Fi Advisors. Reach out today. Yay!